Good morning and welcome back to Real Estate Economics Weekly Webinar Series. This week we're covering San Diego County. This is part 5 of 5 parts covering interest rates, materials prices, and supply chain factors. In our recent webinars, we've looked to a couple of related indicators for metrics on the housing market. One of those would be 30-year mortgage rates. 30-year rates, 15-year rates, interest rates across the board have been at very low levels. I believe the 30-year mortgage rate and the 15 both have hit all-time lows in the past week or two, in part responding to the problems that we're having in Europe, stress on the banks there, stress on the currencies there. We really think that's likely to put a little bit of a lid on rates here going forward. So our 5-year forecast at this point might be representing the upper end of the range. Certainly over the next few weeks and months, we're unlikely to have much upside pressure on rates. In the back years of the forecast, we could get a little bit of rate appreciation as we hopefully have a stronger economy and some of the concerns about bank capital adequacy and that sort of thing play out. We like to look at materials prices. This particular chart is from the Chicago Mercantile Exchange, where lumber is traded every day. This contract is for 2x4 framing lumber, so very relevant to home building and the housing industry. The contract size here is 110,000 board feet. The price on the right side is in dollars per 1,000 feet. So say today roughly $218 per 1,000 feet. The history on this is this was a very depressed contract during the stock market problems and the credit crisis, and then this has gradually recovered into about the first part of May, and we've given literally all of that recovery back. We've taken this contract back about 6 or 7 months, and to me this is suggesting that the loss of the federal government tax credits and just economic conditions on their own are suggesting a soft second half of the year for lumber demand. There are not that many reasons why anyone would buy this and hold this. It's not something that would age well in your yard. Even wholesalers, can usually acquire lumber on fairly short notice, so it's not really a stockpile item. So this is probably tying pretty close to expectations that the back half of this year will be a little bit soft in terms of new housing production. Copper is a second material that would also be vital in housing, but this has many other uses outside of housing. Copper is generally known as the commodity with a PhD in economics, in that it very carefully tracks or correlates well with a lot of different economic activity. This is something that could viably be stockpiled and held for investment and just for strategic needs. This is a 25,000 pound contract, also traded on the Chicago Mercantile Exchange, and the prices are again in the right hand side where we dropped under about $290 on today's action. You've seen we've had a pretty big sell-off here, not too dissimilar from lumber. I think as the market has started to recognize that the economic recovery is going to be slow and in fits and starts, and we've got a little bit of the expectation here that the second half of the year might not be as robust as was anticipated 2 or 3 months ago. We like to also look at the supply chain. This is Louisiana Pacific Corporation, publicly traded company, trades on the New York Stock Exchange every day. Louisiana Pacific makes engineered wood products like oriented strand board, subfloor systems, different things like that. That are very relevant to the housing industry. You can see on the left-hand side of the chart, this stock took off from under $3 and ran right up to $6 when there was the perception that it wasn't the end of the world in terms of the financial markets, and we weren't looking at an apocalyptic economic downturn. Then throughout, this is a year chart I should add, over the past 12 months we've seen a general trend up in a bumpy sort of way, with the last month or two showing that big ramp up to where the spike top is. So suddenly we are having perceptions that the economy was better than we thought, that housing demand might be better than we thought, sales and traffic were reported as being good, and now we've pretty much reversed that over about the past 5 or 6 weeks. I think expectations have come down quite a bit. And I know there's a lot of concerns about delinquencies, again, bank capital adequacy, the ability and willingness of banks to lend to home builders has come back into the news. A quick summary here: San Diego County has been one market across the country that usually is a little bit of a bellwether. It goes into corrections first, comes out first, and that's certainly trending here. If you've noticed the Case-Shiller data, they've had San Diego price trending higher for 11 straight months. I think that's one of the most positive places across the country in terms of price trending. This is a market that has very good demographic support all across the price ranges. There's good younger populations. The economy's providing demand from working families, and there's also good international demand and demand from retired people. So it's a market that really has good prospects, good income ranges, good age ranges, all kinds of demographic support there. More rental demand will outlet to single-family homes. Now, everyone who lives there knows this is a market where apartment conversions took a lot of rental inventory out of the stock of the apartments, and switched that over to condos during the last boom/bubble. That means the rental stock down there is pretty much run down in terms of numbers, and a lot of people who want to rent will rent to single-family residences that are coming out of foreclosures. We've seen that with high demand at courthouse sales and for short sales and that sort of thing. This is an area that appeals to mature markets. Believe it or not, California is not in the top 15 in terms of states with a budget deficit over 15% of annual revenues. Amazingly, there are states whose deficits are 40 and 50%, but we're short about $1 billion a year, growing by $1 billion a year for pension costs each year for the next 4 or 5 years. So it's not going to take us long to break that 15 unless we can find a political solution to pension costs. This is just a quick review of our products. For those of you who know us, we do national real estate consulting, site-specific work, supply and demand, and one of our specialties, land optimization. Also, you can see our website, www.realestateeconomics.com. There is our housing transactions report. That's the maps we presented in part 1, new housing profiles and statistics, and much of the information we presented today is from our residential economic report. Here's our team. Mark Bowd is the principal and founder. There's his contact information. I'm John Mulville, presenting for you today. Call me if you have any questions about today's presentation. I'll be happy to dialogue with you about anything of interest. On the bottom left is Judy Dooley. She's new subscription sales for our website product. She's the lady with the deals and really can tie you into the right product for your needs. And for our current subscribers, Sandy can really help you leverage our information and our data into your business needs and make sure you get the most out of your research dollars. It's the end of part 5, San Diego County. Check our website for upcoming webinars and the different areas we'll be talking about in the next few weeks. I'm John Mulville. Thank you for joining us today.